Accounting has been defined by the American Accounting Association Committee as the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of the information. This may be considered as a good definition because of its focus on accounting as an aid to decision-making. In 1941, the American Institute of Certified Public Accountants had defined accounting as the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions and events which are, in part at least, of financial character and interpreting the results thereof. With greater economic development resulting in changing role of accounting, its scope became broader. There are multiple functions of accounting. The first one is that it helps us in keeping systematic records. The second one is that it helps us in protecting the business properties. Thirdly, it helps us communicating the results. Fourthly, it helps us in meeting legal requirements.
Accounting can be divided into several areas of activity. The activities we will discuss briefly can overlap and are closely connected to each other. However, it is still useful to distinguish them as accounting professionals tend to gain specialization around these various branches. So, financial accounting is the periodic reporting of a company's financial position and the results of operations to external parties through financial statements. The financial statements include the balance sheet, that's the statement of financial condition, income statement, the profit and loss statement or the P&L, and the statement of cash flow. Hence, financial management focuses on external users. Management accounting. Management accounting emphasizes the preparation and analysis of accounting information within the organization. According to the Institute of Management Accountants, it includes designing and evaluating business processes, budgeting and forecasting, implementing and monitoring internal controls, and analyzing, synthesizing, and aggregating information to help drive economic value. The basic concern of management accounting is cost allocation. Hence, most of management accounting used to be called cost accounting. Auditing. Auditing is the examination and verification of the books of accounts and the business's system of internal control. Auditing is done both internally and externally. External auditors are independent firms that inspect the accounts of an entity and render an opinion on whether its statements present fairly the financial position of the company and the results of operations. The external auditor's primary obligation is to users of financial statements outside the organization. The internal auditor's primary responsibility is to company management. They ensure effective and efficient operations, the reliability and integrity of financial and operational information, safeguarding of assets, and the compliance with laws and regulations and contracts. Tax accounting. Tax accounting is based on laws enacted through a highly political legislative process. Tax accountants help entities minimize their tax payments. Within the corporation, they will also assist financial accountants with determining the accounting for income taxes for financial reporting purposes. Fund accounting. Non-profit entities use fund accounting, including government and not-for-profit corporations. Rather than seek to make a profit, governments and non-profits deploy resources to achieve objectives. There are two types of funds generally, general fund and the special purpose fund. The general fund is used for day-to-day operations like paying employees or buying supplies. Special funds are established for specific activities like building a new wing of a hospital, etc. So the last one is forensic accounting. Forensic accounting is the use of accounting in legal matters, including litigation, support, investigation, and dispute resolution. Some of the forensic accounting engagements are bankruptcy, matrimonial divorce, falsification and manipulation of accounts or inventories, and so on and so forth. Forensic accountants investigate and analyze financial evidence. Moving on to the process of accounting. Identify the transaction from source documents like invoices, receipts and loan documents, etc. Then we would record the transaction as a journal entry into a journal. An entry generally consists of the date, the name of the account, and debit or credit transactions. Now we post the entry into the individual accounts in a ledger. Traditionally, the accounts have been represented in T accounts, with debit on the left side and credit on the right side. Some examples of accounts are accounts payable, receivables, and property accounts. Consolidate ledger accounts into a trial balance at the end of the reporting period, which could be quarterly, semi-annually, and annually, by netting all the debits and credits in each account to calculate their balances, totaling all the left side, that is the debit balances, and the right side, that is the credit balances. Adjustments like depreciation, amortization should be made at this stage. The two columns should be equal. Finally, the last step is to combine the sums in the various accounts and present them in the financial statements created for both internal and external users. For example, profit and loss account, balance sheet, cash flow statements. Close the books for the current month or the current period by recording the necessary reversing entries to start afresh in the new period.
Revenue is simply the number of dollars or other currency that a firm receives for selling its output. Depending on the situation, it may make sense to think in terms of total revenue, or it may be more helpful to break revenue down into average revenue or marginal revenue. Let's examine each of these quantities in turn. If a firm sells all of its output for the same price, then total revenue is simply the selling price times the quantity sold. As you can see here, total revenue, which is oftentimes abbreviated TR, is just price times quantity. So for example, if I sell 12 apples at $2 each, then my total revenue is just the price, which is $2, times the quantity, which is 12, or $24. Notice that the total revenue has units of dollars or whatever currency it is that you're working with. If a firm sells different items, or even the same item at different prices, then total revenue is calculated by multiplying price times quantity for each item, or each price point, and then adding the amounts together. So we have here, total revenue is just the price of the first item times how many of the first item you sold, plus the price of the second item times the quantity of the second item that you sold, and so on and so forth. Now this isn't for every individual item, it's just for every individual category of items. So for example here, say now we're selling 12 apples at $2 each, and
hard to breathe.